Hi, everyone. Welcome back to another episode of 10,000 Roads to Financial Independence. Today, I have one of my first encounters with Syndicator, Arleen Garza, over here. Arleen is a principal and co-founder of REEP Equity. Arleen oversees the operation aspect of multifamily portfolio, and Arleen has launched her real estate investing business in 2012. She and her husband began with a small 24-unit property, which they owned and managed. So, as a principal in REEPs today, they have sponsored a total of 17 multifamily acquisitions, taking 6 properties full cycle. And currently, her multifamily portfolio consists of over 2,700 units as deal sponsors and over $300 million invested in San Antonio, Atlanta, Dallas, Jacksonville, and Houston. Wow, quite impressive resume. Thank you so much, Arleen, for joining us today.
Thank you, Eliza. It's great to be on with you and to reminisce. I do remember when you came to San Antonio and you in advance said, hey, can I stop by and see what you guys are doing? And so happy to see your success since that point. I think it was 2019 or 18. I can't remember.
2018. Yes, absolutely.
Okay.
Yeah. Thank you, Arleen. And one of the story I just want to kind of tell the audience how I met Arleen is through a networking event. Essentially, it was my first time starting doing the apartment syndication, not even like starting doing, just kind of want to get someone's head around that syndication. And Arleen was like, come on by my office. She's like super welcoming. And so I went to their office in San Antonio at the time. And I think Arleen has already had over thousands of units in her portfolio. And she walked me through like how their operation works and all that. So it's people like her, make knowledge transfer possible and made it possible for us to learn from greater syndicators than we ourselves. So it's really great to kind of see that full circle and have Arleen our show today.
Oh, thank you, Eliza. Yeah, I believe that somebody helped us when we got started, helped me learn the ropes, and so I think it's my obligation to help others. I mean, I was blessed, and so I should continue those blessings and carry them forward.
That's awesome. And which kind of transition to our first questions in the show oftentimes is, Arleen, when you're thinking back, is there a person or incident that was instrumental on shaping the entrepreneur that you are today?
Well, I'm going to cheat a little. I'm going to give you the first person, and then I'm going to talk about more recently. So my father. My father came from a large family, and so as sometimes happens, back in their times, he only went as far as 8th grade because he needed to work to help the family. And so he worked in oil field construction for quite a few years, and he taught himself how to read blueprints and really educated himself so that he could rise up in the different construction companies. So he ended up as a construction supervisor for some large multinational oil and gas construction companies. And what happens in the oil fields is, as you may have seen over the last year, prices go up and down. And when prices go down, they tend to lay off a lot of people. And when you have 10 kids, which is what, I have 9 siblings, you're always being creative and trying to figure out, how do I make sure I can afford to support my family? So he started a construction company on his own in the city we lived, or the town we lived in, and the neighboring towns, building carports, roofing, all types of construction projects. And so I would see, him in the evenings working on, the next project he was going to be involved with. And it just impressed me, because to come from so little education and to be able to figure it out was just very, very inspiring to me to see that.
Yeah.
And the second person would be my husband. He started a property management software company at the age of 26.
Wow.
And when he came home and said, hey, what do you think if I quit my job and start a company? I didn't hesitate, because I was in banking. I had a pretty steady job and we could survive on my income. So I said, sure. I mean, sky's the limit. Now's the time to do it. We didn't have kids. We didn't really have big obligations. And so I watched how he grew that company from just himself and a partner to 100 employees, and then sold it in 2007 for a very nice multiple. So he has also been a big inspiration for me.
That's amazing. That's amazing. And just kind of made it possible to have the limitless mindset is influence osmosis from other people surrounding you. And
Yeah.
I understand that your company is a vertically integrated, which means that you do your own management and also like kind of have a full control over your house essentially. Um, can you kind of walk us back to, when you're transitioning from a full-time job, working in banking, into become an entrepreneur? What kind of goes through your mind, and what the opportunity is like? Yeah.
Sure. Well, I transitioned in kind of two stages. So the first was when we left Dallas, lived in Dallas before and moved to San Antonio. I had some clients that I did consulting for, small businesses, on kind of how to grow their businesses and the right target, audience for them, et cetera. And that came from my background at the bank. And so I did some consulting for a few years, kind of on my own time. I picked the projects that I wanted and did that until, my husband said, he saw the back end of the financials from the clients he had on his software. And he said, multifamily investing is really what I want to do. And so, being very conservative, I said, hold on a minute, let me get my arms around this. So as I started looking and reading, and we actually joined the apartment association and became apartment managers and certified apartment portfolio supervisors. And so through that process, I really gained a lot of information on risk management, really how to drive NOI, what are some of the things you need to know? And so I really gained a comfort level. So when we started in 2012, I felt more comfortable. And that first one was very interesting. We managed it ourselves. So I did the leasing, the accounting, the marketing, and he did all the rehab and managed the maintenance side of it. So I really felt from that experience that I understood at the ground level what needed to happen on a property for it to be successful. And, when that property sold at a 370% return, I was hooked. I'm like, I don't know of a better way to make, some really great returns. So from there, we, started buying, and we managed our own until we hit about 450 units.
Wow.
At that point, we got a mentor, and he recommended that we try third-party management. So we did. But I think we knew too much. So I would find that I would spend, hours after the month was over, combing through the GLs, sending emails. What is this? What is that? What are you doing to, boost occupancy? You name it. I had a list.
Yeah.
And we did that until we hit about 1,000 units.
Mm-hmm.
Once we hit 1,000 units, which is what we had been told is kind of a magic number to have your own management company. So we relaunched, we brought all the properties back in-house at the time, and hired, our first hire was an accountant.
Mm-hmm.
I have an HR background, so I could do the hiring.
Yeah.
Jacob has an operations background, so he could do a lot of that. So we hired an accountant, and then we hired a regional manager. And so those were our first two employees on the management company side. So, as we started buying, we started adding, but we always hired ahead of what we needed. So I basically built an org chart and said, these are all the functions that need to be there to be successful.
Mm-hmm.
And we plotted and determined in what order we would hire people.
Wow.
So, after the regional, we did hire an HR manager.
Mm-hmm.
And so we started building the team from there. And that's what I would recommend to anybody that's looking to scale is look at what responsibilities and duties are needed and what is the type of person that you would need to slot in to do that for you. Because as we learned, once we went third party, the benefit was we were able to grow because we weren't so involved in the business that, we weren't working on the business, we were in the business at the time. So hiring the right staff, even if it's a virtual assistant in the beginning that can help you with your database or marketing or whatever it may be, understand what it is you want to do and what it is that you want to hire somebody else to do for you.
Yeah, that's that's amazing. That's an amazing story. Arlene, you just packed so much information over there and a very specific as well. It really kind of helped me also laid out a roadmap on how our hiring would be in terms of, because
Sure.
that's usually oftentimes the small business are pounding their head on. And can you kind of give me a little bit more stories about your first 24 unit deal and what kind of went wrong in there and what kind of, and then what you learned from these experiences and to make 375, almost 400% of a total return. How do you do that? Can you tell us a little bit more about that?
Okay, well, the day we started due diligence, the gentleman that owned the property drove up in a green pickup truck. He pulled out a big suitcase from the back of his truck, put it on the hood, opened it up, and there were all these papers. And he said, that's all the documentation for the property. So,
Yeah.
at that point, it was like, okay, we can do this. And so we actually had to create the financials. And we were lucky to work with a banker at Wells Fargo that understood this. And so we worked together with him to build the financials to a point that they were comfortable with it. And, the rehab budget was key because what we knew was that the property had really good bones. We knew that. And so it was a matter of determining what were the dollars going to be spent on that would help us drive the revenue.
And how did you learn?
So we know is, curb appeal gets them in your door. And then I'm sorry,
Oh, how did you
repeat
get
that,
that
Eliza?
knowledge? Like, how did you have that knowledge transitioning from like working the full time? I'm assuming you're still working the full time at the time. This is kind of like an investment that you're making. How did you like know what investment kind of drives the ROI?
Well, we did have a partner. We had to bring a partner on because although we had a strong enough balance sheet, we had no experience. So the lender wasn't going to lend us any money without knowing that somebody on the team knows how to run a property. So we actually had met a gentleman that's, pretty well known in our market. And we started a relationship with him, he and his wife, and we said, we're really interested. And he said, when you find your first one, I'll partner with you. So he and his wife invested $20,000 total. But what it got us was experience.
Yeah.
And so I literally sat with him, my husband and I sat with him and said, okay, what are the nuts and bolts? What are some key things that we need to know to avoid those big mistakes? We didn't have any partners other than him, so it wasn't as stressful as today when you're syndicating.
Yeah.
We're very responsible for other people's money.
Right.
So he walked us through, he shared some of his vendors that he had used on his properties, and that was a huge help. So I would tell anyone listening, really build your network. Find some folks that have done this before, get a mentor, work with a partner that already has experience, because that's going to save you a lot of headaches and a lot of problems. I think you asked about challenges. I think the big challenge in the beginning was wrapping our arms around the financials to where we could understand it. What we did know is that the property is way below market on rents. And the units were big. They were large units and it was centrally located. So we knew location was good, which is where we start today. I start looking at location. I don't even look at numbers until we build a crime map. We understand what the schools are like. We understand what is driving jobs in that location. And we did that then, and we still do that today. But there's almost a checklist you have to build of questions that you have to answer. and actually have done that for some of our training, is built an acquisition checklist.
Yeah,
Here's some questions you need to ask before you even look at making an offer.
that's amazing. That's awesome. And Arlene, you're very process driven, as I can see that. um,
Yes.
yes, and then which is important in building a business. And so tell us a little bit more about your first syndication. How did you decide that you wanted to do syndication? I'm assuming prior to that you were buying with your own money, and also kind of going through, um, so the kind of growth a little bit slower. But how did you kind of transition into doing syndication?
Sure. So the first syndication we did was 143 units. We'd already bought the 24 unit, and then we bought a 28 unit around the corner with our own money, and that same partner, that we had on the first one, with the idea that we could actually hire, at least part-time management staff for the two, since they were so close to each other,
Right.
and give us a little more time. So, but when we got to the 143 unit, we knew that we didn't need to exhaust all our cash reserves because we were going to need capital to continue to buy. So we joined a real estate group in San Antonio, and we started to build our investor database. And from that, we were able to do the first syndication in 2014. So 2 years after we started, we did our first syndication, and it was from individuals we met and established relationships with in that real estate group. And, I will tell you that for people to invest with you, they need to know, like, and trust you. So we had to build that trust with these investors over that period of time before we were even comfortable asking them to invest.
Yeah, yeah, definitely. Trust is very important. And then in 2014, I remember it's been a while now. But I know we had a down cycle during 2008, 2009, 2010. I think 2014 things are kind of looking up and up, but then maybe people are still kind of a little bit worried about going down cycle. Like, what are some conversations you have with your investors that kind of make them feel comfortable to invest and trust their money with you, into your first syndication?
Right. I think what helps us is that my husband did have a business background. So he had run a successful business before. So that was important to share with folks. And then from my background, I had been a lender. I had managed an HR team nationwide. I managed a marketing team nationwide. And so we were able to show how all of those skills translated into this new business. And having those two smaller properties, we were able to show experience. I mean, that's always important to anyone that's looking to invest with you, is what is your track record? That's key. And so those are some things that we initially shared about us. But what we also needed to share from the multifamily side is that, the value of these properties, as you know, is strictly driven by the income they generate. So, changing the mindset from kind of the stock and bonds mentality of, investing in that, this was an alternative investment that we could show it's a physical asset. People need a place to live. It's, in that time, it was workforce housing. And what is it that's driving this? Or jobs and population growth. And so pulling all that data, I'm a big data person. I'm constantly reading reports about a market, a sub-market, because I don't think you should just look at the big market overall. Like, example, San Antonio. Those properties were in Balcones Heights, which is actually a small little town within the San Antonio MSA. So sharing all that data really gets investors comfortable with what are they investing in. And you should also show them, stress the property, stress the numbers. How low can occupancy go before there's an issue in paying your bills and paying the mortgage? And we set a standard of always knowing that number so that you could share that with investors and for ourselves. I mean, we invest our own money into every transaction, and we want to understand, what are the potential risks and how do you minimize, how do you de-risk a deal? And those are the things that we share.
Got it. Got it. And let's kind of switch gear a little bit. Actually, I have one more question to ask about this. Now, owning the small property, building a track record is a great way. I love that because you're putting your money first, taking all that risk first before you bring the investors in. I think it's a great roadmap. But compare the small property that you own and the large property you own. What is the verdict? Is bigger really better?
Well, I would tell you that we have determined 150 to 250 is kind of our sweet spot in terms of the number of units. We do own a much larger property, 344 units. And the way I look at it is it's like a small town, right? You've got to constantly be feeding traffic into that little town, that property, because if you look at the average turnover in the apartment industry, it's 50%. So if you look at 50% of your units potentially turnover every year, you have to have that machine built on, what do you put into the unit so you minimize your turnover cost? How do you staff it appropriately so that you're constantly getting the best of the demographic in that area? And so I would say that with your bigger properties, you just need to be a little better at the underwriting in terms of really understanding what the minimum numbers are that are going to make that property successful. Because it's a constant, I mean, it's a lot of work, but it's also very rewarding. I mean, the property has done well. We're looking at possibly selling it soon. Our only challenge is that prepayment penalty that we know a lot of properties have, but it's a hot market. So we really are looking at some options for the property, and it's done well, but I probably would never buy over 400 units. I just think that's a big endeavor.
Yeah, that's amazing feedback to know that don't want to buy over a 400. Now that's interesting because people always say don't do it less than 100 when you first start to do a deal because you can use onsite and etc. So it's very interesting to know that there's actually a limit on like don't go over 400 in terms of what you kind of take on. What would you say is a good size property to buy for someone kind of just started into syndication?
I would say, 75 to 100 units. I think anytime you get, I think the numbers over 60, you can at least have part-time management. But I think it also depends on whether somebody is going to hire a third party. It's a little more expensive on a percentage basis to pay a management company. So just make sure you build that into your underwriting. It's not uncommon to have 4 to 6, even 7% management fees. So as long as you build that in, I think for your first one, you do want help, either a partner that knows what they're doing or a third-party management company that specializes in that size of an asset.
Yeah.
And going back to the previous comment on 400 units, very doable, but I think you have to have a really large organization. We're getting there. We're not quite there, but I do think you have to really look at how many resources do you have to put towards an asset.
Gotcha. So it's like personnels. And then we know it's not easy in the property management side of the business. The attrition is definitely a problem over there. So Arleen, tell us a little bit more about. I'm gonna ask a few questions on vertical integrations, how you manage that. So thank you so much for sharing us your kind of hiring roadmap over there. What do you think is the most essential positions for someone's kind of looking into the property management? You mentioned about getting a regional, which is kind of your supervising over on your site, and then obviously getting an HR manager and accounting, and you have backgrounds in HRs and etc. So if you were to kind of do it all again, looking back at what you did there, the sequence of like the people that you put in place for someone who owns 1,000 units and more.
Right. So, I would still hire the accountant first because I do think the numbers and managing your receivables and your payables, that's your income inflow and income outflow. And so to me, I would still start with that person because it's very detailed information and everybody wants reporting, right? The lender wants reporting. Your investors deserve good reporting. And so I think accounting, to me, whether it's somebody that's full-time or you outsource it to a bookkeeping firm or an accounting firm that will do that task for you, I think that's super critical. The regional manager we brought on because a regional should be able to hire too, right? Because they've hired a lot of people in their experience. So that's why that was number 2 for us, because they could serve dual purposes until we were really big enough to need an HR manager where you're managing benefits and, leave and all kinds of, HR related items. And so that's why we chose that order of hiring, because those were key elements. I mean, the people run your business. We were in Houston a few weeks ago and saw some on-site folks. We visit our properties at least once a month, if not more. If a property's in rehab, Jacob and I personally will visit them because we want to make sure that we put eyes on the assets and that we can tell our investors that we put our eyes on the assets and that the rehab is going well or whatever's happening at the property. So that's important. The regional can do that for you and report in, but there's nothing like, seeing it yourself. So I think those are key things.
And then in terms of cost efficiency, once you kind of switched over to the vertical integration model, what benefits does your investor get from that?
Well, I think the biggest thing is that we control every piece of it. I mean, the buck stops here, good or bad, it stops here. And what I found, here's an example. We decided to bring all the utility billing in-house. And what we found is that on the expense side, paying for utilities, we dropped it, I have 20%.
Wow.
Because we were making sure that we monitored the bills that were coming in, that they were accurate, that didn't have a spike from one month to another without an explanation. And so that was a key piece of the expense side of it. On the income side, we increased the capture rate almost 15%.
Wow.
What happens with utility billing is people move in and out of a property. If the service that's doing it for you isn't on top of it, you might miss a month's worth of billing. Well, in our case, no, our VP of operations supervises that with our utility billing coordinator. And so they're watching that piece of it. So on the expense side, when we take over a property, we're able to reduce controllable expenses 10 to 15% just by renegotiating contracts, sometimes even with the same vendors that the seller was using. So, one property, I think we took it from about $3,900 in controllable expenses, right? No insurance or taxes, because that's kind of beyond everyone's control sometimes. And we dropped it to $2,800. So even on a 6 cap, that's an $800,000 immediate increase in value to that property. So for us, we believe that us doing it, we're watching every penny. We're watching every dollar that comes in or goes out of the property. And it's more work, but I sleep better at night knowing that we're doing that.
Yeah, that's amazing. That's amazing. That is a lot of work, especially for 17 properties. Now, you guys have done a lot of full cycle deal. Very impressive. What would you tell someone, or what would you tell investors on things that you would want to take a note on exiting a property? Because everybody is always focused on the acquisition. Some people will focus on the operation a little bit more, but then pretty much no one talks about what happens when you sell a property. Because you have so much experience, can you share with us what should someone be expecting when they exiting a deal?
Sure. Well, I think one thing that's important is your debt. What type of debt do you select for that property based on your hold period? When we were buying, no one expected rates to ever drop, right? They just expected them to go up. And so we had fixed rate financing, agency financing on our, first acquisitions because that's what was widely recommended.
Yeah.
And once the pandemic hit and rates just bottomed out, the prepayment penalties on these properties got really, really high. So that really made your consideration of an exit much more difficult because then you're trying to sell on a loan assumption basis, or you're trying to get a much higher all cash offer to absorb that prepayment penalty.
Yeah.
And, as this all started to happen, I actually was fortunate to speak to one of the top guys at Pensford, which is the company that provides the interest rate caps for floating rate loans. And they had done a study over the last 20 years, and floating rate debt generated a much better return and all that, looking at all those properties that had traded than fixed rate debt.
Wow.
In today's environment, it's a big discussion. It's a big debate. Do you put fixed rate debt on it because it's so low, or do you float? And I think it just depends on your exit. Are you planning to hold, 5-7 years? Then maybe fixed rate may work, but run your analysis both ways. And that's what we do today, is look at it both fixed and floating. That's key. I would say the second thing is when you're considering selling, start a year before that, before your target sales date.
Yeah.
Really start looking at your occupancy, really start looking at your expenses. And those two things I think are key. The occupancy and your net rental income are super important because that's going to drive the purchase price of a property. I mean, that's probably the biggest contributor to NOI. And, start to make sure you might have more of a balance of less rent growth, but higher occupancy. It's looking at what's the right balance with those two things, and start doing that a year out, because remember, they're going to look at T12. Now, your T3, your last 3 months before you put a property for sale, are more critical, but they will still look at your trend over a 12-month period.
Yeah.
And they'll look at your occupancy trend over a 12-month period. So start to look at those things a year out, even before you would consider selling.
Yeah. And then just to kind of, for a listener who are not very familiar, who are not like a apartment queen like Arleen are, T3 and T12, it stands for the kind of like the financials for a property, the expenses, and then the income statement for the last 12 months for T12, and T3 last 3 months in terms of that financials. Just want to make sure that our listener knows what we're talking about, which is great. And Arleen, like what is next? And the other thing I noticed is that you started in San Antonio, which is really kind of your local market, and it's great for vertical integration. But then now you have actually expanded your business into Houston. So how do you do that with a vertically integrated company? Because oftentimes people kind of get a little pigeonholed into one area and thinking that they couldn't get out of to other markets.
Sure. Well, our strategy is to really be very market focused. So we did that with San Antonio. We didn't buy anywhere else until we had built enough scale to really have all the layers in place at the management company. So, as we started to look at Houston, I looked at all the data. Again, what is job growth? What is population growth? What does the renter demographic look like? So San Antonio, 51% of the households rent. Houston, that number is 58%.
Wow.
So I knew there were a lot of renters in that market. Houston just has a lot more inventory. I mean, whereas San Antonio may have 700-800 properties, Houston's got 4 or 5 times that in multifamily. So I knew the inventory was much better. And looking at the market demographics, they are number one in population growth in Houston.
Yeah.
So as we started to look at Houston, we said, okay, how do we go into that market? What are we going to need? So our VP of operations that we hired managed over 14,000 units across the US. And that she also had a big presence in Houston. So she knew the Houston market well. So the directive was hire the strongest community director for that first property that could really kind of serve as the catalyst for hiring additional as we added to the portfolio. So we did that in August of 2019, but I started in January of 2019, traveling to Houston, driving markets, meeting brokers. And what I did was I asked the Houston brokers the San Antonio brokers that I'd worked with to make an introduction to the Houston brokers.
Yeah.
Because then I was able to make a lot of headway. Other than waiting for them to get to know us, they kind of had an endorsement, for us coming in the gate. And so we did that. I mean, I spent probably an hour with one broker, and she walked me through all of the submarkets around Houston, telling me what areas she would recommend, what areas were growing, what areas she would not recommend. And so from that experience, I had a lot of data. And then I went to several economics, folks that were presenting in Houston. I went to those events to really understand the market and the submarkets. The biggest piece was the submarkets. And so from that, we said, okay, we know enough about the market. We like it. It behaves very similar to San Antonio. It's just a whole lot bigger. And we had the broker relationships in place. And so we just started sharing with them what we were looking for, with the understanding that as we added properties, for example, today we have 4. We'll close on our 5th one next month, but we added an area manager. So not quite big enough for a regional, but an area manager who manages a property and oversees the other 3. But we hired very strong managers at those other 3, so that they're more self-sufficient. And as we grow, we will eventually add another regional into that market. But right now we've got really good coverage with the area manager.
That's amazing. That's the first time I've heard about an area manager. That's a great insight. Every time I talk to you, I just learn so much more about operations. The investor's mind at ease, because they know they're really working with someone who knows the ins and outs of the business very well, so that they can do nothing and they receive the passive income. And you mentioned that you also passive invest as well, which is oftentimes a lot of syndicates don't do it because they are very much in control. It's more the control factor. They invest in their own deals and etc. So can you tell us a little bit about the thought behind, you also passive invest as well?
Sure. Well, it's also very strategic. We are, have been interested in the Dallas-Fort Worth market. And so, 2 of the properties we've invested are in Dallas-Fort Worth. And it was to really gain an understanding of that market, to see the numbers from an actual property operation standpoint. Atlanta, that was another market that we were interested in. So we passively invested in a property there. Jacksonville, Florida is the other property that we invested in, again, because there was interest in learning more about that market. And, honestly, a lot of it is IRA dollars, because I can't invest those in our own deals. So it was twofold: strategic to learn a market, and 2, allowed me to invest my IRA dollars.
Yeah, that's amazing. That's awesome. And so what's next, Arleen? I know you guys own almost 3,000 units now, and expanding into different markets. You mentioned there's a few other markets that you're interested in. What does the next, 5-year look like for you? 5, 3, 10 years, whatever long-term means for you, midterm.
Well, right now, as you said, we're almost at 3,000 units. We will be at 3,000 when we close the next Houston property. So our big goal is to be at $1 billion in assets within 5 years.
Nice.
Yeah.
And then, so what's the why that's driving that?
Well, I'm glad you asked that. Our daughter recently joined our company. She's a portfolio analyst.
Yeah.
She'd worked for a company in Miami that was a multifamily company for a year and a half, and she decided to join us, which I'm very happy about. And then our son is studying real estate finance and development. So he wants to build them from the ground up. So, you know, for us, it's a legacy business. Luckily, they both are very interested in the company. They worked with us in high school. Our daughter was in leasing and our son was in maintenance and leasing.
Nice.
So they've grown up with the business. And so our why is we want to build something big that they can take over and build even bigger.
Nice, nice. That's awesome. And then you just answer my last question usually over here, which is how are you helping your children grow financial literacy and then helping them encourage them to be financially literate? Yeah.
Well, you know, one of the things that helped early on is my husband and I would always talk a little bit about work. We'd ask the kids, you know, at dinner, we were big on having dinner together every night.
Mhm.
We'd ask them how their day was, you know, what was the highlight of your day? And then we would share highlights of our work day, which was very business related.
Mhm.
And you don't think they're listening sometimes, but they're really listening. So, you know, it was planted as a seed very early on. And then working at the properties, they really learned, you know, the value of what we were doing. When our daughter was in leasing, she came home one day and she said, Mom, there was a lady that came in. She's probably, you know, 35. Our daughter was probably 16 or 17 at the time. She said, and she told me she couldn't, you know, pay her rent. She said, so I sat down with her, found out how much money she, you know, made, what her car payment was and her rent. And I showed her that she could afford her rent.
Yeah.
She just would have to, you know, lay off of eating out and some of that. So, you know, she learned to show somebody a budget without really realizing that's what she was doing. So that helped. And then we invested some of their college money
Yeah.
in multifamily.
Mhm.
And so when they started to see the distribution checks, which they were not allowed to spend, they had to save them, they saw the value of how their money can grow.
Yeah.
I had our daughter recently do her schedule of real estate owned from the properties that we've invested
Nice.
for them. And she was amazed, you
Yeah.
know, at how it had grown over time.
Yeah. Yeah. In a short period of time too. Sometimes it can go pretty fast. And you know, and
Yeah.
one last question is like, how do you actually then being a busy businesswoman? I think it's a really unique position over here. How do you balance a work life, you know, essentially spending time with the family and doing business? Because we know when you're starting up a business and building that into fruition, it takes a lot of long hours. And what's your kind of like couple of tricks to make sure you know spend enough time with family, or not necessarily, or mindset to reach that work life balance. It's not necessarily always people think about you know life, but it's a balance for every person. Different things.
Yeah, and I think the balance is different for everyone, right? I think for me, it was understanding when I needed to be available for the kids.
Mhm.
And so it might mean that I get up early and take care of some things. Our son ran cross country, so by 5 o'clock, he was leaving the house.
Yeah,
And I got up and I made him breakfast every morning for him to take with him. So when his run was over, he would have something to eat.
yeah,
And my husband would make lunch at night and pack it and leave it ready for them. So those were some small things, but again, I made it a priority to be at their events, which is why I love this business. You're not tied to a desk. You don't have to ask for permission. You can be at their events.
mhm,
And I think it's important for kids to see you there and supporting them. And then dinner.
mhm,
You know, I would make sure I was home by 5:30 at the latest so that I would have dinner for them. It wasn't always home cooked, just depended on how my day went, but it was just sitting together and having that conversation that I thought was very, very important. Now, after they went to bed at 9,
mhm.
I might stay up for a few hours doing some work, But I made sure that the time they needed me, I was available. And, you know, I got a really beautiful letter from our daughter when she graduated from college or from high school, thanking me for being at her events, thanking me for, you know, sitting with her while she was doing her homework, taking her to church. I mean, those were things that were important that you don't realize are important until after they're a little older and can communicate that to you. So I just think it's finding the priorities and making them priorities,
Mhm.
and you'll always find time for everything else.
Yeah, yeah, that's amazing. That's amazing. Except for sleep, obviously, over there.
Yeah,
But
I'll sleep when I'm 70.
not even. And Arlene, so this is such an amazing session. I learned so much myself, even from this interview. Thank you so much. And how does people reach out to you? How can people find you? How can people find more about REITs equity? I believe you guys also do bus tours, like showing properties and etc. for investors, so they can really see kind of what's going on the ground. How can people kind of get involved there?
Sure. Two great ways. You can go to our website, REEP, R-E-E-P, equity.com, or directly send an email to invest@reepequity.com. And we have an investor relations coordinator, Rebecca, who will promptly respond to emails. Or if you directly want to speak to me, she's happy to set up a call with me and I can share what we're working on. But our investors are so very important to us. They make things happen. And so we'll always make ourselves available to speak to them.
That's awesome. That's awesome. Well, thank you so much, Arlene, for spending the time with me today and giving us all these great go nuggets. Definitely worthwhile for me even to go back and listen to some of these as well again. Thank you so much today.
Thank you, Eliza. It was awesome to speak to you again and get to see you. And congratulations on your great success as a mom, as that woman that's balancing life. So congratulations.
I have something to look forward to. I have someone role model to look forward to.
Well, reach out anytime.
Thank you.